Good day, ladies and gentlemen. My name is Emeka. We'll be discussing accounting today. Today we'll be taking accounting, we'll be looking at accounting, we'll be taking a glance on accounting. It's what I call accounting trend. A summary of what accounting is all about. And that's what we'll have on the board here. So I'm just going to give you a little time to look at it before I come back, then I'll carry you on along with it. Okay, welcome back. Now let's see what we'll have on the board. Let me start explaining them one after the other. But before I start explaining it, I'll have to explain what accounting is all about. Give you a brief definition of accounting. Accounting was actually found by an Italian monk called Luca Paciali. Yes, Luca Paciali in the year 1894, accounting was found. He was a monk, like a priest, an Italian priest who was in charge of the finance back then. And now let's look at what we have on the board. I said I'll be taking care of accounting in a glance. I call it, this is my own innovation. I like to call it accounting trend. Like what we have on the board. See, accounting trend, accounting in a glance. Now let's take it one after the other. Now in an accounting word, though we have what we call bookkeeping, we have what we call bookkeeping, and we have what we call accounting. Accounting and bookkeeping are a little bit similar, but bookkeeping is just on the recording part, while accounting has to do with directing, interpreting, and some other higher duty. Now let me define what accounting is. Accounting could be defined as a social science that is prepared in order to record, analyze, explain, direct, and coordinate all financial transactions of an organization in order to aid the management to make decisions. In order to aid the management to make decisions. That is what accounting is all about. Now, in accounting, the first thing that will come to your mind is, where does an accountant get his information? Now, before, accounting is all about, is historical in nature. It's all about past events. The accountant gets his information from the source document. That is the first one we have here. You can see how the arrow is moving, the arrows, but I want to start with source document. What is a source document? A source document is the first destination of information where the accountant draw the first information before passing it to the subsidiary book. Now, what are the examples of source documents? We have the receipt, we have invoice, we have credit notes, bill of lading, and so on and so forth. Then from this source document, the accountant now transfer the information to the subsidiary book. He now transfer the information to the subsidiary book. What are the subsidiary book? We have 5 major, or we can call it 6, if we include the journal proper. We have 6 major subsidiary books. The first one we have is purchases journal. Purchases journal is a subsidiary book where all transaction that is carried out on credit in terms of purchases, all goods purchased on credit are recorded in. Then we have what sales journal is, where all goods bought on credit or where all goods sold on credit are recorded in. Then the next one we have what return invoice journal. Return invoice journal are those where you record all those returned goods either due to damages or oversupply. Same thing goes to return outwards, reverse the case. Goods that are bought on credit that have damaged are recorded down into the return outward journal. Then we have journal proper. Journal proper is the journal, it's also known as general journal, that summarizes the whole journal, the whole day book. It's either you call it day book or you call it a journal. Any transaction that is not of cash is recorded in the journal. Then finally we have the cash book. We can also call it a cash ledger. We call this cash book. We have different types of cash book. We have the petty cash book, the one that has to do with what? Float, recording of float, and day-to-day petty expenses. We have the one-column cash book that has amounts. Then we have double-column cash book that is being prepared by a bigger business that has a bank account for the business. Then finally we have three-column cash book that offers discounts and receive discounts. These are the subsidiary book. This is the second destination of information. In fact, actually it's the first destination because the source document is the source of information. Then from this subsidiary book, it will be posted down to the principal book. The principal book of account is ledger. That is the specific account for various transactions in the cash book or various transactions in the journal. Now, in the principal book of account, which is the ledger, it is subdivided into two. We have two types of ledger. We have the real ledger and the nominal ledger account. Under the real ledger account, we have personal and impersonal account. Personal account is the ledger open for humans, while impersonal are the ledger open for assets and tangible materials. Then the other one, nominal account, is account that is open for things that are not tangible, things that you can touch. Example, the bank account, rent, stationery is impersonal. We have bank account, purchases account, sales account, cash account, and so on and so forth. That is where you post it is in the nominal account. Then from the principal book of account, we move straight to the trial balance. As the name implies, trial balance is a kind of a book that is used to compare all the balance in order to trace error or to check if the transaction is being balanced. That is what we mean by trial balance. Every balance brought down will be taken to the trial balance, either the debit side or the credit side. Then if the trial balance does not balance, then there is a trace of error in that financial transaction. There is a trace of error. But for temporary base, you can balance the trial balance with the suspense account, depending on when you find out the error. Then we're talking about error, different kinds of error, compensation error, overcasting error, complete reversal entry, error of principle, and others. Now, from the trial balance, we move to the final account. The final account is divided into three. It's divided into three. They are trading account, profit or loss account, and balance sheet. Now, on the part of the trading account, this is the account prepared on trading base, that has to do with anything concerning trading. Before the deduction of overheads or expenses that are not for trading expenses. Now, this trading account has to do with the purchasing of goods, the opening stock, the closing stock, and finally to get the cost of goods sold. How do you do it? You subtract the cost of goods from sales in order to give you the gross profit or gross loss. How do you compute cost of goods sold? You add opening stock, add purchases, add carriage inward, less return outwards. It will give you cost of goods available for sale, less closing stock. It will give you cost of goods sold. If there is warehouse expenses, you less it will give you cost of sales. Then from there, it will give you what we know as the gross profit. Then you bring down the gross profit to tackle or take care of various expenses you encountered in the trading activity. Then when you deduct the expenses from the gross profit, if the gross profit is bigger than the expenses, it becomes what? A net profit. But if the expenses is greater than the gross profit, it becomes what? A net loss. Then from the profit and loss account, the net profit will be forwarded to the balance sheet. Now, balance sheet is the final of the final account. Balance sheet is the final of the final account. You can also call it statement of financial position. Now, under balance sheet, it has two sides. The formula for balance sheet is capital is capital plus assets. Capital plus assets. Capital plus assets. Capital plus liability rather is equals to assets. And under assets we have three types of assets. We have the fixed assets, we have the current asset, and we have the intangible assets. Now this is the formula of balance sheet. Now under the balance sheet, let's talk about the capital side. Now the net profit that is being carried from the profit or loss account will be added to the capital. It will be added to the capital. If there is any drawings, it will be deducted. Once that is deducted from it, it will now be known as the owner's equity. Then you add it up to the short-term liability, which is the current liability. These are expenses that are payable, loans and owings that are payable within a year. That's why it's called a current liability. Then you also add it up to the long-term liability, loans and expenses that are paid within more than 1 year. That are paid in more than 1 year. That is long-term liability. Then when you add that up, then if you go to the other side, we have the fixed asset. Now fixed asset is the asset that you can touch and you can feel, that is yielding fund. That is yielding fund for the organization, the business organization. That is what the fixed asset is. Fixed asset is different from property. Let's take this scenario for an example. Someone who owns a private car, you can't call that car a fixed asset unless if he is using that car to help his business. So it is a fixed asset. Examples of fixed asset, we have premises, we have land and building, furniture and fitting, machinery, and so on and so forth. Then the next one on the line is current assets. Now current assets are assets that can be easily converted to cash. That can be easily changed into a liquid form. All those assets that you can easily convert to cash, that is what we call what? Current assets. Examples of current assets, we have the closing stock, we have the cash at hand, cash in bank, we have prepaid income, and we have what? Owing income. All these things falls under current assets. Then finally, the last one we have in the asset side is the intangible asset. We have an example of intangible asset is goodwill. Goodwill, what is goodwill? Goodwill is reputation. When you have a good reputation, your business have a good reputation, it can always yield you more fund. You can collect compensation for the good reputation you have, or you can get more patronage. So it's also an asset. That is balance sheet for you. And this is where accounting ends. You can see a little summary that I've done in accounting. I like to call it accounting trend. We started from the source document. From the source document, we move to the subsidiary books. From subsidiary books, we move to the ledger. From ledger, we move to the trial balance. From trial balance, we move to the trading account. From trading account, we move to the profit or loss account. Then finally, the last, but not the least, balance sheet. I believe with this brief video, at least you can have an insight of what accounting is all about. In the next videos, we are going to be taking them one after the other, different topic in accounting. Thank you very much. My name is Mr. Emeka. Have a nice day.